indeed a great pleasure to interact with people from the UAE, who are all fellow practitioners, and I would say fellow professionals, AML professionals, who are in the business of anti-money laundering. And this is something which is very key currently, to the entire kind of worldwide, because if you see the Basel AML index, what it sees is that there's a growing concern around money laundering, which is coming up throughout the world because of the growth in new technologies and the difficulties which are posed in identification of beneficial owners, resultant disparities in the kind of rigor which financial structures are across the globe. Some countries, it's not a level playing field. So, which works very well for money launderers and those who are financing terror, because it's like water. When, as you know, water, if you spill it on the floor, if there is a gap somewhere, if there's a hole somewhere in the ground, you have to find a way to seep into it. It is the same with money launderers and terrorist financing. They look for the gap, they look for the weak links, they look for the chinks in the armor, and try to see where they can move the funds without being detected. And that is where, as AML warriors, as counter-terrorism financing warriors, you and I have a key role in protecting the financial system. And why is this so? Why should we do this? What is the impact of this? There was a study done some time back from the United Nations Council on Drug and Terrorist on the UNSDCOC, which found that nearly 3.9% of the world's GDP is being utilized, or rather lost through money laundering. And this is why it needs to see what is the impact of that. If money is laundered, then you are not able to use it for various things. You are not able to use it for various productive purposes. So the costs of money laundering are very high, and it has got a lot of impact in terms of the costs are high in terms of human costs like education, good health, services for the sector, for various sectors, for the underdeveloped countries, etc. Money which could go into that is being laundered away. So that is why there is necessity to ensure that countries have a strong AML framework in place which prevents money laundering. If you see what is the cost of money laundering in terms of penalties levied by regulators, in 2023, it was about 6.6 billion. And this was mainly due to the largest fines were that on Binance crypto and payments firm, which accounted for nearly $4.3 billion. And this accounted for the rise in penalties of the global penalties by about 69% and 21%. As the crypto and payments firm accounted for the increase in the global penalties. And this is the reason is because new technologies are developing, and neither the regulators nor the legal entities, the licensed financial institutions, have evolved sufficiently strong measures to ensure that their channels are not used for money laundering. While talking of Binance, what it had done, the Treasury of the Secretary to the Treasury, or US Treasury, Janet Yellen, said Binance had turned a blind eye to its legal obligations in the pursuit of profit. Is willful failures allowed money to flow to terrorists, cyber criminals, and child abusers through its platforms. Let's try to understand what is exactly money laundering. So, the goal of a large number of criminal acts is to generate profit for the individual or the group that carries out the criminal act. And money laundering is the process by which the proceeds of these crimes are disguised, are processed to disguise their illegal origin. And this process is of critical importance as it enables the criminal to enjoy these profits without jeopardizing their source. This is what the FATF had to say on while talking of money laundering. What are the stages in money laundering? You'd all be familiar with those stages, having learned of that when you have entered into that money laundering into the AML space itself. The first is the placement stage, where there is the act of introducing illegal profits into the financial system. So the way the criminals structure transactions, breaking it up into small transactions to escape notice, to escape detection, escape maybe a surveillance system, and introduce it into the financial system. In the second stage, the money launderer will engage in a series of transactions by trying to distance the money launderer from the source of funds by making a series of conversion, movement of funds to different accounts, etc. And then these funds could be utilized maybe in some other location for purchase of property, assets, etc. And then through sales, etc., it comes back also, it can be brought back into the legitimate economy. And this is the entire process of money laundering that can take place. So, why we need to guard against money laundering or terrorist financing is because lax controls impact the integrity of the financial system. The rating of a country, in fact, you see that where the FATF has identified or rather classified certain countries as gray or classified certain countries depending upon their AML controls in place as having low controls and classified them as either gray. Other countries would be reluctant to deal with them, and those countries would make all efforts to come out of that the FATF the classification. So the integrity of the financial system is dependent on the tighter controls. It discourages foreign investments. Nobody would want to invest in a country which has got lax controls, where the integrity of the financial system is suspect, and you do not know the asset you are investing in, the company you are investing in may have something to do with money laundering or terrorist financing. And this has got repercussions for developing countries also in another manner, because it prevents the flow of technology exports to these countries. And developing countries require technology exports more than anything else. And the developed countries will be more reluctant to share the benefits of technology, or share the technical know-how with such countries. So the FATF, as you all know, is a group of nations which it sets standards, it promotes effective implementation of legal, regulatory, and operational measures for combating money laundering and terrorist financing. Each country frames its own legal framework for anti-money laundering and counter-terrorism financing. And India, for instance, if you look at India, it has the Prevention of Money Laundering Act 2002 and the Prevention of Money Laundering Maintenance of Records 2005, which frames the legal structure on which the regulations are built, on which the basis of which the Central Bank of India, that is the Reserve Bank of India, issues the various guidelines for which the regulated entities, the entities licensed by RBI and other regulators also will have to comply with, to ensure that they have sound anti-money laundering framework in place. In UAE, you have the anti-money laundering and combating the financing of terrorism and illegal organizations laws. You have the related cabinet decisions, and you also have, similarly, the supervisory guidance to licensed financial institutions. So let's look at first things first. What are the things which we have to keep in mind while having a robust AML program? One, first and foremost, when a customer approaches you, what is the first thing you do? Is every institution is expected to have a customer acceptance policy. At least in India, that is the concept. You have a customer acceptance policy, which is derived from the regulatory framework and has foundations on the bedrock of the PML Act, and it helps you to identify the customer. It gives you also the principles or the foundations basis which you identify the customer based on reliable documents. And this could be you are able to identify him or trace his identity basis documents like, say, a passport, a driving license, or maybe a national identity. It could be the Aadhaar in India. So this is one, the proof of the address. And besides this, it goes beyond just knowing who the customer is. You need to know what is his business and what is the source of income, what is the source of the business he does, what is the source of income that is generated. And we get the details of that. And at the time of commencement of an account-based relationship, when dealing with an individual who is the beneficial owner, it could be an individual or an individual who is the beneficial owner, an authorized signatory, etc., who is related to a legal entity. You also need to know your customer's business, as I just mentioned, the location of the business, the geographical risk covering the customers, as well as transactions, the types of products, services that he offers. Is it something other, the type of goods that he is dealing with, liable for, say, dual use? What are the delivery channels used for products, services, etc.? What are the type of transactions undertaken, etc.? These are things. So know your customer, know your customer's business, and last but not least, know your customer's customer. Who are your customer's customer? Whom is he dealing with? Is this in line? Is it related to the line of business that he is doing? Like if the customer is somebody who's dealing with medical or pharmaceutical goods, and his customer, or he says that he has dealings with the customer who is not in the same line of business, would raise certain suspicions. So it is something which you need to know, that have a clear idea of the relationship which you are establishing with the customer before going in for going in for an account-based relationship. Have reasonable measures to establish his source of funds wealth. If it's a company, you get the details of the balance sheet, profit and loss account of other partnership firms, etc. You get all the financial details. And in the case of, say, if the client happens to be a politically exposed person, which you find from while you are doing a due diligence on the client, then normally the decision to whether to accept him as a client or not is to be taken at the level of a senior management. And if you take a decision that the source of funds and wealth is sufficient, which he has given is sufficient to establish that it may not expose you to the risk of, say, connecting you with certain funds which have got their source with connected with, say, with political sources of, say, party funds, etc. Like currently, the elections are just over in India, and you would find that typically in many countries, this is a time when large sums of money changes hands. And if somebody comes to open an account and then it shows a large sums of money being deposited into that account, it should be a warning. And all of you are also aware of the Malaysian 1MDB scandal, where money was siphoned off from the state funds and into the accounts of various persons in different locations. And banks in various parts, in various countries, are still suffering and are still having huge penalties because of their exposure to the 1MDB funds from Malaysia. And the golden rule is that you decide to open such fund accounts, then you should subject to enhanced account monitoring on an ongoing basis. Do you classify or do you monitor all your customers similarly? Would that be a right approach? It would not be a very basically a very prudent way of managing your risk, because the resources at the disposal of a financial institution are limited, and it is not possible to allocate the same level of resources for monitoring all your customers with the same level of intensity. And when there are scarce resources, as you know, in most countries, when compared to business, the level of allocation of resources to compliance is far less. So, depending on the risk-based approach, you allocate your resources, your attention, your monitoring where the risks are highest. And that's why there is a need to classify your customers into low, medium, and high risk. Low could be basically, typically, like say, customers who are salaried employees, who are regularly receiving a monthly salary, and generally it may not pose any risk for the institution. A medium risk may be in the lines of business, and where there could be certain, inflows into the account, seasonal, or because of trade with different types of customers, different types of commodities, different regions, etc., posing some level of risk. And then you have the high risk customers. Typically, these would be like people, high net worth individuals, those who are dealing in the stock market, in dealing in precious metals, gold, etc. To take a few examples, could be high risk customers. So the risk categorization will have to be based on the customer's identity, his social financial status, nature of business activity, services, delivery channels, etc. And as per the Indian regulations require that the risk categorization should be reviewed every 6 months. Every 6 months, you review the risk categorization to see whether once the account has been opened, you are in a better position to monitor the account. And if you find that suddenly in what was a low risk account, there is a spate of transactions happening, which is not in line with the stated profile. The customer was supposed to be, for instance, say, a bank employee, receiving a fixed salary. But in the last 6 months, while there's been typically a few salary credits happening over the last 2-3 months, there has been, for instance, a large number of financial transactions happening in that account, which is not in line with the stated profile of being an employee and receiving a fixed salary, or his known other sources of income also. So, which is why we need to probe, find out what is the reasons for this. And for that, the first line of defense is where they have to look into it to find out what is the source of that aberration in the flows into those particular accounts. And if you find that it does not support the profile given at the time of opening that account, you may have to review the risk categorization and classify it as medium or high risk till you get a satisfactory explanation, and you are able to monitor the account more closely over a longer period. The KYC updation should also happen. See the periodically, that depends again on the category of the risk. If it's a high risk category of customer, then once in 2 years, his KYC, that is the particulars of the customer, his residence, his business, whether there's any change in that, all this information you may need to get it upfront. And if there is no change in that, it may continue. But this is not generally a static exercise. Many banks, many financial institutions I have seen view this rather as a static exercise. Yes, the address is the same. He's having the same employment, same business, so no change, and then it goes on. But sometimes they do not take into account any changes which are happening in that account information. Like in the account, for instance, there has been some of the loan repayments have not been coming in time. There has been some payments going out to countries where he has no business to be sending out payments, because he has he does not import anything from that particular country, and he is receiving something or some payments from those countries also, though he has not exported anything to those countries. So those are things which would have to be factored into the risk assessment and into the ad to see whether you need to review that risk categorization. So it's not a static exercise. As part of the entire monitoring system, you also need to have transaction monitoring. This is basically looking at the type of customers who have the red flag indicators which are flagged by regulators, FIU. And this could be various things, like for the UAE, it could be different red flag indicators which are highlighted by the FIU. And in fact, it could be transactions involved with say countries which have poor AML and terrorist financing systems, and significant number of transactions with in countries with known, say with where we know that they are they do not have any links, no business links with that with those particular countries, then you would have ambiguous or inconsistent applications if you are asking the customer for the explanation why it's going to such countries, such locations, or for any alerts. You could also have wire transfers from these accounts, and cash payments will be made and money would be transferred. This money would be transferred to various high-risk countries. It could be to known tax havens also. This could be transferred. And transfers to numerous offshore locations also. There would be no business rationale for that. And sometimes the same home address would be provided for different multiple remitters, etc. So these are certain things. It could also be purchase of various valuable commodities, gems, precious metals, etc. And trade-based money laundering is also one of the things, one of the indicators which have been flagged by regulators, where the invoice would be at a far higher value for a particular commodity. And that is where many countries, or rather many institutions, have tried to find to invest in systems which will help them to identify what is the kind of, whether the invoice price matches what is available in the market, and would it help them in detecting money laundering. So the money launderers try to exploit various channels, and some of these are red flag indicators highlighted by regulators are useful in setting up the alerts. Besides that, you need also to set appropriate thresholds for generation of alerts, because if these alerts are pegged for the thresholds are set far too low, you could land up with a number of unproductive alerts. By unproductive alerts, I mean is that these transactions are not really suspicious. You would have to an X number of hundreds of alerts to cope up with and sift through before you finally decide that these are not really suspicious transactions, and it lead to a lot of loss in time and effort on the part of your staff, which could be spent in productively looking at the better quality alerts. So, which is why, as a best practices, countries, institutions are expected to look at the alerts from the scenarios also, depending upon what is their type of business, their type of customers they have, and also set the thresholds at appropriate levels so that they get productive alerts, which they can examine and arrive at genuinely good quality reports. And the examination and disposal of alerts, you have the 3 lines of defense. We'll come to it a little later. The process for following reporting of suspicious transactions also we'll see in detail. We need to also have a quality assurance. By quality assurance, I will take up this point here because in the first line of defense, you have the front line identifying certain transactions, and these which are the alerts which are generated, and looking at it, and these may be based upon their assessment be dismissed as not suspicious transactions and closed based upon certain set parameters. Sometimes it's the machine also which is the system itself which closes it. So it is necessary that as a system can error, and also people can make mistakes. It is necessary to have a system of having these such alerts which are closed at the first line of defense level, subject to a quality assurance. And there should be an audit trail also to see how these are closed, what is the kind of check, what is the percentage of it which is taken up for quality assurance, etc. So what are suspicious transactions? Transactions which are related to funds where there are reasonable grounds to believe that they are earned from any felony or misdemeanor, or which are related to the financing of terrorism or illegal organizations, whether committed or attempted. This is the definition for suspicious transactions. And as per the UAE, a suspicious transaction refers to any transaction, attempted transaction or funds for which an LFI has reasonable grounds to suspect as constituting in whole or in part, and regardless of the amount or the timing, any of the following: the proceeds of crime, money laundering related predicated offenses, financing of terrorism, etc. And it could be related to the crimes of money laundering and related predicated offenses, financing of terrorism, and it could be intended to be used in an activity relating to such crime. So the operative clause here is reasonable grounds. It is not necessary for the LFI to have proof to say, yes, this is a suspicious transaction based on these things. But if it has reasonable grounds that based on that this is a customer I know, I have done a detailed assessment of him at the time of onboarding. This is his profile. This transaction is not in line with his profile. It is to an unrelated party in a different economic zone or in a different country, which is not known for its anti-money laundering discipline. So I have reasonable grounds to feel that, to conclude that this is a suspicious transaction. So those are the grounds which could be formed the basis for suspicious transaction reporting. So there is a legal basis for the requirement to submit STRs to the FIU. And this is enshrined in the Anti-Money Laundering and Combating of Financing of Terrorism and Financing of Illegal Organizations legislation in the UAE. Also, the related cabinet decisions for its implementation, including terrorism lists, regulation and implementation of the UN Security Council resolutions on suppression of and combating of terrorism financing, countering the proliferation of weapons of mass destruction, and its financing and relevant resolutions. So this is the basis, the legal basis by which the LFIs, that the licensed financial institutions, are required to submit SCRs to the FIU in the UAE. The law requires certain minimum statutory requirements on the part of the LFIs. That is, you have to put in place indicators to identify suspicious transactions, report suspicious activity to the FIU, and cooperate with the relevant authorities, and again, no disclosing information of the data in an STR to the concerned party. You are filing an STR on a customer. You do not disclose to the party, yes, I have filed an STR on you, so I will not extend further credit facilities to you. It is meant to be kept confidential, because otherwise the customer may stop transacting. It will lose value. The law enforcement agencies, FIU, would lose valuable time in following the trace of the money trade, or gathering further information on the customer, which the financial institution may not be privy to. So that would be that is the reason why the information in respect of filing an STR, or even the classification of customers, in fact, into high, medium, low, is not expected to be shared with the customers. Let's look at the first lines of defense. We spoke about a little while back about the 3 lines of defense. I'm sure all of you are familiar with that. So the first line of defense consists of the typically are the relationship managers, business executives, back office operation functionaries, etc. And their role is to timely escalate any suspicious activity, central to timely escalation of suspicious activity, because as the relationship manager, you're the first point of contact with the customer. So you are able also to see the transactions in the account. You know when there are certain, say, transactions taking place which are not in line with this activity, you can ask for that. And in fact, it's is necessary also to see that they are trained for their role. Also, look at the red flags associated with their customers, products, services, delivery channels, the geographies also. And they require the training, also the necessary expertise to identify beyond what they normally see in the course of their normal work, certain other signals, certain other alerts, certain other signs symptomatic of money laundering, which they need to escalate to the second line of defense. And that way they would, this is actually not compromising their responsibility to report suspicious transaction. They should do this also. The second line of defense consists largely of compliance employees, and their role is to provide policy advice, guidance, assurance, oversight, and challenge to the first line of defense. They oversee the investigation program, if it is both, if it is manual or automated. If certain alerts are generated automatically, they will, and this is escalated or they are examined on a manual basis by the first line, and then is escalated to the second line. Their role is to investigate those particular alerts to see if there are certain lines or certain characteristics which would indicate certain grounds of suspicion, which qualifies far greater necessity to probe into them. The compliance would monitor the risk relating to the LFIs, and they report directly to the senior management on the LFI's risk exposure, including through financial crime related metrics they could be having. And the LFI is also required to report, to appoint a compliance officer or money laundering reporting officer. The MLRO is the key person here in the entire AML reporting and monitoring and reporting of suspicious transactions. He reviews, so he or she will be reviewing, scrutinizing, and reporting STRs and other reports pertaining to suspicious activity. He's the one, he is on the basis of the evidence placed in his own investigation, is able to come to a conclusion. He would be raising queries, both from the second line and also from the first line, and come to conclusion whether to the activity is to be reported as suspicious, when necessarily reported within the appropriate time, within the stipulated time frame. And the MLRO is the primary source of contact with both the law enforcement agencies and also the regulators, supervisors, and they would be sharing also, coordinating and with the financial sector, sharing instances, reporting cases, developing best practices, etc. So they play a very key role in the entire system. The third line of defense is the internal audit. This consists of the external auditors, internal audit, external auditors, and the independent testing functions, etc. They are responsible for evaluating the design, the control operational effectiveness of the LFI's compliance program controls, including the technical compliance with AML, CFT policies, etc. It independently identifies any gaps or deficiencies in the entire AML program and also in the operational controls. And risk-based auditing also helps to assist the LFI's board of directors and senior management, because it provides them with a health check on the entire the AML structure, the AML controls in place, and ensuring that wherever there are gaps found, there are deficiencies found. These areas are prioritized for remediation, and this would help the senior management, the board also, in ensuring that there's a provision of adequate resources, oversight, and training for the employees. Reporting of STRs. Now, what is very important is the quality of STR reporting. Merely reporting a transaction as suspicious based on certain grounds of suspicion is not enough. A report should be complete in itself, because otherwise it leads to a lot of correspondence with the FIU when we have to keep on asking for additional information, and may also lead to a kind of reprimand from them on the quality of your reporting. So, for the quality of SCRs and other report types, it is imperative for the FIU to identify vulnerabilities and threats to the UAE's financial system. It should be the quality of the STRs should be good. Develop an overall understanding of money laundering and financing of terrorism and legal organizations based on emerging trends and patterns. This should help the FIU to develop such an understanding. And LFI should review alerts for potential suspicious activity, have policies and procedures that document the process for deciding whether to close the alert promptly or to report the transaction as suspicious, and should also include guidance on capturing detailed descriptions for the manner in which alerts are disposed of by reporting or closure of the alerts. As I said, like if certain alerts are based on certain parameters, can be closed, say, at the L1 level, or alerts generated by automation could be closed automatically, so provided they are in line with certain clearly demarcated parameters. Then there should be a process of quality assurance to ensure that such alerts, you are not erring in posting such alerts, and have an audit trail for them. So, if during the course of a customer relationship, customer transactions happening, the LFI suspects there are transactions relating to money laundering happening, then it should ensure that these transactions are reported to the FIU within a specified time frame. In the case of suspicious activity reports also, if an LFI submits suspects any transaction or attempted transaction relating to money laundering, it should also report it to FIU. And additional information file is also required to be filed with the FIU based on, say, requests. While these STRs, SARs are filed online on the Go AML platform, the additional information could also have to be filed based on a request from the FIU, who may want certain additional information based on the STRs which have already been filed by you. And this is also to be filed on the AML platform. So, stages in filing this. Filing an STR, you use the Go AML portal. Then if you could also have a detailed report, an AML report, which may not be you cannot be using the usual format in the Go AML portal because of the space restriction, but the AML report gives you enough space for the narrative to be built in, which the FIU would require. That is an investigative narrative report format, and it has got three stages, three parts to it. Is a narrative, which is the introduction, uh, the body, and the conclusion. The introduction is the general name of the violation, name of the customer, say against whom it's filed, whether there were any previous STRs, etc. In the body of the report, you include the narrative why it was filed, why was the STR filed, who were the involved parties, and suspected transactions in chronological order. Like if the transactions took place on a particular date during the course of a month, list that in chronological order, giving details of the parties to which the beneficiaries of such transactions, why you are determining that the transaction, why you determine or you suspect that the transactions, you have grounds to believe that they are illegal, the modus operandi of those transactions, etc. And in the conclusion, you bring out any plan or including mitigating steps that you may take, including information about any follow-up actions conducted by the entity. That is, it could be either closure of the accounts, ongoing monitoring, or enhanced due diligence on these accounts. This is an interesting one. Can a LFI file a defensive STR? So, what exactly is a defensive STR? It is something like this: like children when they are in school, they would maybe get into a fight, and say one kid would beat up the other kid, and you would get beaten up in return. But you would go first to the, anticipating that the child may complain to the teacher, go first and report it, say the child beat me. So it is a kind of thing, a defensive STR being filed for transactions that they are not really suspicious, but you merely suspect that sometime in future it may boil down or turn around to a suspicious transaction. And if I don't report it now, it may result in some regulatory penalties. So what is the implication of this? This means that a lot of work at your end, a lot of work at the FIU's end, because no productive information is obtained from it. Because any STR has to have the grounds of suspicion, why you're filing that STR, the parties to the transaction, the chronological order of the events, and it's a kind of, it has to be substantiated with instances like these transactions took place on such and such a day. This is why I have a suspicion that we are with certain customers, or rather with certain beneficiaries or no relationship with the customer, certain other jurisdictions where he does not have business interest, etc. Making out a clear case. But here, if there is nothing like that, it's difficult to establish or rather have clear grounds of suspicion. So the CBUAE considers defensive STR as indicative of an inefficient transaction monitoring system and weak internal controls also. And the UAE's FIU had also noticed that there were instances where SIRs and STRs are reported by LFIs without not receiving, because they did not receive supporting documents. They reported this to the FIU. But later, if they had waited, got information, sifted through that information, and they would have been able to safely conclude or arrive at reasonable grounds to suspect there is a suspicious transaction. There are timelines, again, for disposal of the alerts, which I think you're all familiar with. Recommendation on decisions to file an STR within a maximum period of 35 business days from the date of automated alert generation. For a complex investigation, this could involve different jurisdictions, different accounts. So it could be done, say, within 15 days of initial STR, within 15 days of the alert generation, and follow to be STR to be submitted within 30 days of filing the initial STR. And on continuing activity, the LFIs can implement enhanced monitoring on such account holders. After the, what do you do after filing? Now that you have filed the STR or the SAR, what do you do? Do you keep quiet, continue business as usual? No. You maintain confidentiality, no tipping off the customer. But at the same time, you monitor the accounts to ensure that there are no further suspicious transactions taking place. You would not want, while under your watch, while the customer is your customer, him doing certain transactions which turns out to be money laundering transactions. If the intent is to continue the relationship, identify or rather categorize the customer maybe as high risk, have a process of enhanced due diligence on the customer's transactions, and also obtain senior management's approval for continuing the relationship. And you need to document the reason, rationale for taking the decision, because these are certain things which at a later date, if things escalate and you find that there are more transactions involving this particular customer, which you may have to look into, and which also potentially fall under the STR categorization. This would require kind of the regulator would be looking at why you have decided to go ahead with the relationship. The other way, besides the documenting reason, follow the enhanced due diligence process, restricting the customer's use of products and services, putting it under an approval group, putting limits on transactions, volumes, etc. So, what are the best practices which you can? What I have seen from the different jurisdictions is every jurisdiction plans an annual AML risk assessment and a risk mitigation exercise at the start of every year, every calendar year. And in that risk assessment, they look at the business they do, their customers, the category of customers they have, the business they are in, etc. And they incorporate the threat areas which are identified by FIU supervisors, etc. Analyze also the implications of change in risk categorization. If a significant number of customers have moved from, say, low risk to high risk, it means that you need to see what is the reason for this. You need to see also whether your controls need to be tightened. Is it because of certain business products you offer, certain laxity in controls, etc.? Again, at the time of launch of new products, technologies, you need to assess what are the AML implications of such new products you are offering and ensure that you have a risk mitigation plan in place before launching such products. And this is why we come to Binance. Binance is basically what was dealing with cryptocurrencies, and it started in 2017 as a cryptocurrency platform. But from there, its growth was rapid. It resulted in doing certain things which were not in line with regulatory best practices, or in fact, ordinary practice. It did not register with FinTedu as a money services business. It did not implement comprehensive KYC protocols or monitor transactions. It never filed a SR with FinTedu, and it facilitated trillions of dollars of transactions on its platform, generated over $1.6 billion in profit. This was from the US Department of Justice press release of November 21st, 2023. What did it lead to? It led to illicit actors using Binance Exchange in various ways, conducting transactions that obfuscated the source and ownership of cryptocurrency, transferred illicit proceeds from ransomware variants moved proceeds of darknet market transactions, exchange hacks, etc., and scams. And it did not implement controls that would prevent US users from trading with users in Iran. And between 2018 and 2022, it willfully caused over 898 million in trades between US users and users ordinary research.